Can you imagine someone controlling more wealth than any country?
I'm standing in front of the headquarters of a company that manages $10.6 trillion.
Is BlackRock evil?
They don't seem good.
They're pretty much running everything. A billionaire to these guys is nothing.
What if I also told you that it's very likely you are responsible for the funding of this company and allowing it to do what it does?
This isn't some fantasy world. It's BlackRock. Yep, it manages $10.6 trillion, over half of the US GDP. It owns stakes in 95% of Fortune 500 companies and shapes the world's economy. They call themselves passive investors, but are they really? Let's dig into the truth behind BlackRock and the other giants, Vanguard and State Street. Are they just watching or secretly pulling the strings? BlackRock takes your money, invests it, and aims to make more. Their secret weapon? Index funds. Created in the 70s, index funds let you invest in bits of every company in a market, rather than risking it all on a few. Less risky, more profitable. These index funds are part of mutual funds, pools of money managed by companies like BlackRock. Their main products? Index funds and ETFs. They're low risk, consistent, and cheaper. Instead of constantly buying and selling stocks, BlackRock just buys a little of everything and holds on forever. This passive investing loophole means they own massive amounts of stock without worrying about selling. Why? Because they're not allowed to sell as long as a company stays in the index. Most of the money BlackRock manages isn't theirs. It comes from big investors like pension funds and insurance companies, but the cash actually belongs to regular people like you and me. If you've got a 401k, insurance, or a college fund, your money is likely in BlackRock's pool. Public and private pensions, along with retirement accounts, are tied to the trillions they manage. Even though it's your money, you don't control where it goes. BlackRock, Vanguard, and State Street earn profits from the fees they charge for managing assets, not risky stock picks. So how does BlackRock boost its profits? By growing the market value of the assets they manage. That happens in two ways: winning new clients or getting existing clients to trust them with more money. When you're managing $10 trillion, those assets need to be spread across everything. This is where universal ownership comes into play. BlackRock holds shares in practically every major company on the stock market. They don't own the entire company, but they have a decent slice, typically between 3% and 10% of shares. Now, 3% might not sound like a lot, but don't be fooled. When it comes to corporations, even 5% can make them the single largest shareholder. The big three, no doubt about that. These three giants collectively control about 25% of shares in most major companies, but they're not really trying to sell these shares. Dumping all their stock at once could actually tank the market.
We should all understand that just three Wall Street firms, one, two, three, BlackRock, State Street, and Vanguard control $22 trillion in assets, which is roughly the equivalent of the entire gross domestic product of the United States of America. Three companies.
This is where the whole passive investing loophole kicks in again. They buy up shares and hang on to them. Instead of looking out for the bigger picture, their focus stays on one thing: growing their assets under management. After all, owning stock isn't just about making money, it's about power. The more stock you hold, the more votes you get in company decisions. And guess what? BlackRock holds a lot of voting power. But remember, it's not even BlackRock's money. But the moment that money gets handed over to an asset manager, voting rights go with it. That's right. When your pension fund manager gives your money to BlackRock, they also hand over your say in how companies are run. So BlackRock is making decisions for companies you might not even know you have stock in. You might be thinking, okay, so BlackRock gets all these votes. How do they use them? Here's where it gets a little eyebrow raising. Asset managers usually always vote in line with what the company executives want. Why would they do that? Let's rewind to the 1980s. Back then, company executives spent money on corporate perks. Investors weren't too happy about this, so they came up with a solution: stock options. By tying executive pay to stock performance, managers became more interested in pleasing shareholders than in spending money on anything else, like better pay for employees. This strategy shifted company priorities. Instead of investing in the company's workers or long-term growth, managers were now laser focused on maximizing corporate profits. They want to funnel that cash back to shareholders. In the end, it's all about keeping investors happy, not employees. Back in the day, regular people had a bigger stake in the stock market. In 1945, 94% of stocks were owned by households. Today, not so much. Households now own just 40%, and half of that is held by the wealthiest 10%. The top 1% alone controls 50% of corporate equity and mutual fund shares, while the top 10% own 86%. Despite what you might hear about stock market success benefiting everyone, the bottom 50% owns almost no shares at all. The real winners? The top 10%, especially the top 1%. And it's asset managers like BlackRock who call the shots. Corporate Corporations boost profits by cutting costs, and the easiest target? Worker pay. Asset managers like Blackrock play a big role in wage stagnation by voting for strategies that prioritize short-term profits. While shareholders see their profits grow, workers are left behind. This doesn't just hurt workers, but also consumers and small businesses. Less disposable income means less spending. And here's the fun part. Universal ownership could be driving prices up. BlackRock owns big chunks of companies like Nike, Adidas, and Lululemon, so they profit no matter which brand wins. But if these companies started slashing prices to compete, it could hurt BlackRock's returns. Lower prices mean lower profits, leading to anti-competitive behavior. In a competitive world, each company's shareholders will be rooting for their company to beat the competition. But when the same shareholders own large portions of multiple companies in the same industry, there's less incentive to push for aggressive competition. Why fight each other when you're both making the same people money? This is one of the risks that come with universal ownership. It can lead to less competition, higher prices, and less creativity. It's like a monopoly without the mergers. Companies don't need to combine when profits all flow to the same shareholders, like BlackRock. With large stakes in almost every major company, it has connections in high places. Between 2014 and 2015, they held over 1,500 private meetings with companies. They even give companies a year to improve before stepping in. But BlackRock's influence doesn't stop in boardrooms. There's a revolving door between them and the government, including the U.S. Treasury, Federal Reserve, and international bodies like the IMF and the World Economic Forum. Since 2004, BlackRock has hired at least 84 former officials and central bankers. Larry Fink, BlackRock's CEO, even aimed for a spot as Hillary Clinton's Treasury Secretary. After the 2008 crash, BlackRock got a deal managing financial stability. The government tried regulating them, but BlackRock ramped up lobbying and ad campaigns to dodge the oversight banks face. Yep, BlackRock decides if they're passive enough to avoid more government scrutiny. Every year, BlackRock and other asset managers send letters to certify they're following passive investment rules. They get to self-certify. And it gets better. BlackRock's biggest investors? Vanguard and State Street. And guess who owns chunks of Vanguard and State Street? Yep, BlackRock. Surprise, surprise. It's a loop where asset managers own each other, making it nearly impossible to lose when you're your own competition. So does BlackRock own everything? No. But do they control almost everything? Pretty much. They profit from every part while staying below the radar for total control. So BlackRock doesn't need to own everything outright, just own shares in everything. That gives them massive control without micromanaging every company. This universal ownership keeps growing their slice of the pie while the rest of us get smaller pieces. Agencies like the Consumer Financial Protection Bureau and FDIC want to regulate asset managers like BlackRock, but no dice. Regulation is tricky when the ones needing regulation have this much influence. BlackRock didn't create this system, they just learned how to game it to their advantage. But the real question is, do we deserve a system where the people who generate the wealth get a say in where it goes? Well, there you have it. If you like this video, keep an eye on our channel to keep digging into the true realities of our world. Until next time, thanks for watching.